Hi, everybody. Welcome back to Ox Talks. It is Sunday, December 10th, 2023. Hope all of you are enjoying this Sunday and hope you have had a great and productive weekend. I just recorded about a 15-minute video and realized that my microphone lost its juice about a couple minutes into the video. So, of course, it was a masterpiece, but can't hear it. So, starting over here, maybe this one will be a little better. Maybe I will have a little more insight, given that I had shared a fairly long article, which I think is important from Forbes about the jobs report and breaking it down and saying, look, despite what the jobs report showed on Friday, we are still heading into and are in some industries, in sectors, in a recession already. Important information for us to know because the spin that's given to these data points that are put out by the mainstream is unbelievable. And it takes something like this to look through, dissect it, and say, wait, take a step back. It's not what it purports to be. Before I get to the article, I want to say thank you to all of you for watching the videos and supporting the channel. I decided to start this channel. I've been watching JB for 6-7 years now do his thing, but I decided that it was the right time because the culmination of all the events that I see unfolding in a major way in the coming year and even into 2025, it just led me to want to be out here doing my best to awaken all those that will listen, all those that will share the videos, subscribe to the channel. And so I really appreciate all of you. The comments have been fantastic. And all I can say is please like videos, please subscribe, please post this stuff on your social media, put it out there to all those people that you know, friends, family, colleagues, coworkers, anybody that will not be offended by you trying to wake them up and have them understand what we are going to be encountering in the next year or couple of years. So again, thank you very much to everybody. Yesterday, I got a 99.9% positive comments from the Cars and Coffee that I did with my dad. And we made a nice memory. And again, sometimes we need to break the loop. We've got to get out of the daily grind. There's nothing wrong with going to a Cars and Coffee or whatever activity you like to do. Go do it. There's a lot of negativity out there every day. We're always grinding Monday through Friday. And so it's nice to take a little break and just unwind a bit from what we're being bombarded with every day. Okay, the article that I saw today on Forbes, again, I'm going to read a bunch of this today. I apologize for that, but it's very data specific. It's number intense, and I can't really summarize it without screwing it up. So I want to spend the entire time today on this one article because I think it's so important. And it says, despite strong jobs report, recession still locked in, from Forbes. It says from Robert Barone, contributor, that's the author. It says November's jobs report surprised to the upside. The non-farm payrolls report, the NFP, rose 199,000 jobs, close to the 185,000 consensus view. But it was the sister survey, it says, the household survey, abbreviated HS, that shocked the financial markets as it rose 747,000, more than doubly offsetting its 348,000 fall in October. So it isn't a surprise that the unemployment rate, it says, fell from 3.9 to 3.7%, as that rate is calculated off of the household survey, it says. The fall in the unemployment rate will play to the hawks, it says, at the Fed meeting next week. Market odds of when the first rate cut would occur, which had steadily moved forward from June to May, and lately some significant odds of it occurring in March, have now been moved back to May and June as a result. Fed hawks, meaning those members of the voting committee of the FOMC that will not be in favor of reversing course, will not be in favor of cutting rates, which is what all the market cheerleaders are out there saying is going to happen, telling you to go buy a home, go buy a car, don't worry, rates are coming down. That's not what this is indicating. It says when compared with other recent data, The inconsistencies in Friday's jobs report are striking. And here's why I want to read you a lot of these data points because it's important information. Number one, the NFP report, government, education and health, and the return of striking auto workers, which was 30,000, accounted for 178,000 of the 199,000 jobs that were reported as created. The first two categories, government and education health, are non-cyclical, it says, and therefore say little about the state of the economy. That leaves only 21,000 from the cyclically sensitive sectors. Again, you don't hear that. CNBC doesn't tell you that. It says there were 35,000 downward revisions, 35,000 jobs were downward revised to prior NFP reports. It says, listen to this, negative revisions have become standard fare, now totaling 372,000 year to date. So prior reports have been revised down by a total of 372,000 year to date. That is astonishing. And again, they revise it when no one's paying attention. It's a month later, they slip it in, but they report these things as awesome coming out of the gates. So understand what the psychology here and what's going on. It says, on a seasonally adjusted basis, retail employment fell 38,000 in November after losing nearly 5,000 in October. This, along with the Challenger report showing the lowest level of retail hiring for the holiday season in a decade, illustrates the view told to us by retail management at their Q3 earnings presentations. And it says, quote, the holiday shopping period will be slow. The leisure hospitality sector, which showed up as a depressed 7,000 in Wednesday's ADP payroll report, came in at an unbelievable 40,000 plus in Friday's NFP report. One of these, it says, has to be off. We suspect the NFP number is the one that's off, as there are a lot of, they say, there's a lot of corroborating evidence for the ADP data point, which came in showing that there was a loss of leisure hospitality sector jobs. So if we use ADP's leisure hospitality number, minus 7K, and take into account the downward revisions, minus 35K, then the cyclically sensitive sectors of the economy actually contracted slightly in November. And it says other employment indicators, the JOLTS job openings and labor turnover survey for October, the latest one, showed a fall of 617,000 job openings to 8.73 million. Looking at some detailed job openings in the retail sector, they fell by 102,000 and are at the lowest level since April 2020, it says. This is yet another detail that makes us skeptical, sorry, that's not a word, makes us skeptical of the 40,000 of retail hiring in the NFP report. And it says the NFP and HS reports will likely be, well, there's a couple of data points here that I almost missed. The University of Michigan's Consumer Sentiment Survey, it says, for November indicated that the jobs hard to get category was the highest reading since March of 2021. The S&P Global PMI Manufacturing and Services surveys for November served up the weakest employment component since the 2020 lockdowns, as his job listings by major recruiting firms continue to fall. All in, data from the economy outside of the NFP and HS reports lead us to conclude that the labor market is weakening and is thus far from the strong markets headline that that you would be led to believe. As observed earlier, data revisions have been so negative side all year, and we suspect the same will be the case for November's job numbers. So, you know, this is important. This is what we have to hear. This is what I need to hear. This is what I'm doing. I want to convey to you, and that's why I'm spending all this time today on one article. So it says the Fed. The NFP and HS reports will likely be fodder for the Fed's policy hawks. And while the recent inflation data has been very good, the Fed doesn't like the financial markets, especially the bond market, anticipating policy moves. It says lower rates loosen financial conditions in anticipation of a change in Fed policy. The lower rates. In this case, given the hawkish tone of FOMC members, looser financial conditions appear to be inappropriate at this time for this group. This is, we expect Chairman Powell to push back hard on the market's anticipatory moves during the post-meeting press conference next Wednesday. That's December 13th, using the jobs report as ammo, it says. So, and then let's talk about the category addresses the industrial economy. This shouldn't be a surprise to our regular readers, as in recent blogs we've discussed the recession that has already taken hold in the U.S.'s industrial complex, which is the main consumer of many of the commodities in the CRB index. So as the following chart shows, the ISM manufacturing PMI has been in contraction, that's less than 50, for 13 months in a row. Hence our call that this sector is already in a recession. Also, the ISM Services PMI is barely growing, 52.7 in November. A move below 50 for the services index will likely change some attitudes about the economy's soft landing. That's all we're hearing. Is soft landing is on deck. Don't worry, the Fed has engineered a soft landing, or will. And then let me conclude here, talks about the Fed in closing. Besides interest rates, it says the Fed controls the level, and we talked about this, the level and growth of the money supply. The monetarist school of thought, the Milton Friedman school, has a strong case that inflation is tied to money creation. Shows a chart. This is now for nearly all of 2023, and for the first time in the history of the series, M2 money supply is in contraction mode as the Fed has sold off and continues the process most of the bonds it purchased during the pandemic. According to the monetarist school, inflation should be on the wane. It says that's exactly what it has been doing and will continue to do for the foreseeable future. You guys can make up your own mind on that. Are you seeing costs of food come down? Are you seeing costs of everyday necessities and goods that you need to provide for yourself and your family coming down? I'm not. Maybe it's trailing some other sectors, but that time will tell. It says to add to this, commercial banks, and this is another issue we covered last week and the week before, commercial banks have stopped lending. Since credit is the lifeblood of the U.S. economy, this is yet another indication that the odds of a recession are high. So, there is what I believe an amazing encapsulation, broken down item by item, which shows you, if you just read the CNBC headlines, the CNN headlines from the jobs report last week, you wouldn't get this takeaway, you wouldn't get this analysis. So thanks for your patience on me reading a bit more today, but I wanted to share it with you. I will leave it there. I have a really busy week this week, a deposition I'm taking on Thursday, which I have to spend several days preparing for. Court reporter set up, ready to go on that. I have to get a motion for an injunction on a real estate matter prepared and filed for a hearing this week. So rolling along, hope all of you, especially those that have your own business, are working hard. The grind never ends. There are no days off. Those that don't have your own business, consider, bringing some of your talents to bear, working for yourself, and making yourself more resilient to what we see now as an onslaught of layoffs and more coming layoffs, in my opinion, next year. Again, not giving financial advice or legal advice, but this does not look good. It's not a matter of doom and gloom. It's a matter of just reality. And you're either going to be awake to it or not be awake to it. If you're awake to it and you've got some dry powder, some money set aside, if you're working on your credit score and you have a good, debt to income ratio, you're going to be able to, in my opinion, take advantage of huge opportunities coming in all the sectors: real estate sector, commercial, residential, the auto markets, the stock markets. We're going to see this stuff, in my opinion, at much lower levels in the coming year and couple of years. I did my workout this morning on Sunday, which I always do. Felt great. I hope all of you got your steps in today, got some exercise in, some strength training. With that being said, we're right about 15 minutes. Maybe this video is a little smoother than the last one, so everything happens for a reason. Again, thank you all from the bottom of my heart for joining the channel, subscribing, and watching the videos. Let's continue to get the word out. I will see all of you tomorrow. Have a great night. Bye.